SVOL's dividend has been cut 3 out of the past 4 months. Its NAV has been eroding, and people are not happy about it. This is Ethan, CFA Charterholder and investment professional, and today I'm going to dive into why SVOL's dividend has been cut, how far it might go, why the NAV has been eroding, and a strategy you can use to overcome both of those things and use SVOL to create a growing investment with a growing income stream. Let's dive in. We did a full review on SVOL, the Simplify Volatility Premium ETF, in this video, so I'm going to assume you've already watched it and skip a lot of the basic details in this one. But to be fair, I did say this. SVOL has been paying around 15 to 17% income, give or take. And if you take out all of that as income, your income will not be sustainable and will fall over time. I'm confident of that. But if instead yes, I did stop there on purpose. We'll get into the strategy of how to beat it later, but SVOL's recent income drops should not surprise anyone. Let me explain. SVOL has three basic features. They short VIX futures with about a quarter of the portfolio. They implement 4 strategies to limit risk to about the same level as the stock market, and they invest the remaining 75 or so percent of the portfolio in income-producing securities. Here's the key thing to understand, though. Where does that 15 to 17% yield that they've been paying out come from? Obviously, not all from treasury bonds, right? Unlike most income investments, most of the return and income in SVOL do not come from income-producing securities. Those are part of it, but the main source is the, quote, roll yield on the VIX futures positions. Don't let the name fool you. It's not really a yield, as in a payout. It's just the return you get from time passing by. This is the VIX futures curve as of January 3rd, 2025. Notice how they go up as you get further and further away. Or maybe what I should say is, notice how they go down as you get closer to the present day. That's called being in contango, and the VIX futures curve is almost always in contango, except in times of very high volatility like during a market crash. The VIX is commonly referred to as the fear index. I explained it in much greater detail in the other video, but for this one, the key is that these prices usually go down as they get closer to present day. So, what happens when you sell one of these short, aka bet on it to go down, like SVOL does? Well, obviously, in any given day, you can lose money if the VIX goes up and make money if the VIX goes down, but even if the VIX stays flat, there's a sort of gravitational pull almost, which causes the VIX futures to go down as they get closer to present day, aka as time passes by. And what happens when futures go down? SVOL makes money. The gravitational pull, as I'm calling it, is referred to as the roll yield, and it's the main source of return for SVOL. But like I said, it's not actually an income stream, it's just price appreciation. What's interesting about SVOL is that it doesn't just keep these returns in the fund and allow the NAV to reflect them. They estimate what their return will be from VIX futures, income producing securities, and anything else they own, and they try to pay it out all as an income stream. They try to smooth it out and keep it as consistent as they can, but the income and returns in the underlying investments will move around. And if they're trying to pay it all out as yield, the yield will inevitably move around too. That doesn't mean it will always go down like it has recently, it just means that it will not be perfectly consistent. So, to understand why the income has been falling lately and how far it might go, we have to look at the two main components of the distribution, the roll yield and the income producing securities. Let's start with the income producing securities. They own a lot of them, even more than I'm showing here, but you get the point. It's things like core bonds, municipal bonds, high yield bonds, treasury bills, and what's happened recently? Well, if we go back to the end of August, right before they started cutting their dividend 3 out of the last 4 months, here's what happened. The red line is where interest rates on treasury bonds at each maturity were on August 30th. The blue line is where they were on December 31st. You can see that at the front end of the yield curve, the Fed had cut rates by 1%, so those T-bills are going to pay about 1% less going forward than they were before. And I'm only guessing, but since they try to smooth out the yield, they might also be baking in even more rate cuts in 2025 since many people expect the Fed to keep going, albeit at a slower pace. At the same time, rising inflation expectations have pushed up the yields on intermediate and long-term bonds, where you see the blue line is higher than the red line. Those are smaller portions of the portfolio, but they're more sensitive to interest rates, so they likely took some losses in those bond funds. I think these are two key contributors to the falling income lately. But there's an even bigger one. Remember, most of the income comes from the roll yield, right? That's when the prices go down as they get closer on the VIX futures. Well, In times of high volatility, they usually sell the second month contract. Right now, that would be the one at $17.44. In times of low volatility, they sell longer term futures, usually 4 to 6 months out. Currently, they've got a combination of those: the contracts that expire in February, March, and April, or the second, third, and fourth month contracts. So let's see if I can bring this in here. The percentage contango here, right here, that's the amount a VIX future would earn in roll yield if the curve stayed in the same position for a month. So if you owned the second month contract, which expires in about a month and a half, you'd make 4.49% as its price rolled down from 17.436 to 16.686. Make sense? So there are two things to notice here. One, the further out you go, the flatter the curve usually is, and the lower the roll yield usually is. When volatility is really low, they typically sell futures further out into the future, further away from today, I mean, which limits downside risk, as I explained in our first SVOL video, but it also reduces the roll yield, and thus the yield the ETF will be able to pay out. Number two, the second thing to notice is that those first couple numbers, the 4.49%, 2.17%, and 1.29%, especially the earlier ones, are kind of where they'll typically be invested, with more emphasis on the earlier ones when volatility is high. Well, let's take a look at where those roll yields were over the past couple of months. Let's go back to August 30th, where I started the other charts. Okay, here we go. This is what it looked like as of August 30th. Volatility was low, so my guess is they probably held more of the longer term ones, but I'm not sure. But then look what happens. The VIX goes up a lot, and those roll yields toward the front of the curve start to go negative a lot of the time. I can't see where they were invested daily, but knowing their strategy and knowing that this is the main source of their return, which is what they use to produce their income stream, it's really no surprise that their yield took a hit. The roll yield was negative for a while, and that's the main source of their yield. The yields on short-term bonds fell, and that's the second biggest component of their yield. And then they also took some modest losses in their longer-term bond positions. Now you can see we're back to more of a normal VIX futures curve. The Fed isn't likely to cut rates as fast anymore, and long-term bond rates already adjusted to reflect the higher inflation expectations. So I wouldn't anticipate the income to keep falling like it has been from here. However, there is a pretty wide range of possible outcomes. Their VIX futures positions are going to be earning some combination of these numbers in roll yield each month. The numbers always change, and as we saw, they can go negative when volatility is high, and that wasn't even that high. Here's where the VIX futures curve was at the end of each quarter from 2008 through March 2009. They stayed high and in backwardation for basically the entire time, which means going up as they get closer and time passes instead of going down, and giving you a negative roll yield instead of a positive one. In this scenario, I can imagine SVOL's yield getting basically to zero. Now, how often do we have global financial crises with a year-and-a-half long sustained downturns? Not often. And because of SVOL's bond positions and risk mitigation strategies, it would likely have overall held up better than the S&P, but if there's a sustained period of negative roll yields, which would only realistically come in a long-term sustained equity downturn, it would turn the primary source of yield from positive to negative. Of course, they'd also likely capture some nice upside in the recovery since they move to the shorter-term futures when volatility is high, and that's where the most upside potential is. For a more realistic range in normal times of ebbing and flowing volatility, here's how I'd think about it. Those roll yields I just showed you, they're going to move around a lot, but let's say they're generally, over the course of a year, on average, across the different maturities they own, going to be somewhere in the range of 2 to 8%, since they mostly focus on the front end of the curve where yields are higher. This is just an estimate, of course. 2% per month on 25% of the portfolio would translate into a yield of about 6%. If the roll yield averaged 8% per month, that would translate to a yield of about 24%. Then add on the bond yields of, say, 2 to 4% on 75% of the portfolio, and then subtract out hedging costs, which they say average 1 to 4% per year, subtract expenses, which are 72 basis points per year, and you're looking at roughly a 5 to 23% yield over the course of a typical year. I'd say it's not that likely to get to the extremes on either side very often, and it technically could go beyond them on very rare occasions, but my estimate is it'll typically be somewhere in that range, probably actually more likely in the 10 to 18% range most of the time. This is sort of a rough back of the napkin style math, so it's definitely not precise, but Hopefully, this process gives you a better understanding of why the yield fell and where it might go in the future. Going forward, here's what I'll leave you with. A lot of people have been complaining about the falling yield. You cannot expect it to stay perfectly consistent. A lot of people have also been complaining about the NAV erosion. You cannot expect it to grow over time. That's because they're trying to pay out all their returns as income, and they're estimating what those will be. Market returns change over time, and SVOL is definitely not immune to that. But there is a strategy you can use with SVOL to create a growing income stream with a growing yield over time. Let me show you. A lot of people misunderstood this strategy when I presented it in the first video, so I'll lay it out more clearly this time. A common comment was that reinvesting all the dividends is not income. Yeah, obviously. That's not what I'm saying, though. When people buy something with an 8% yield and they take it out, do they say that it's not income because it's not paying 16%? No, they just say they're getting an 8% income stream. So, how is this different? Well, the answer is that with my strategy in SVOL, I think an 8% income stream could actually be sustainable in the long run, whereas most other strategies that just pay an 8% yield, it probably won't be. So here's how it would work. You'd reinvest all the dividends, 12%, 14%, 16%, whatever inconsistent dividend you're getting from SVOL. Then you'd set up a systematic withdrawal plan of a more realistic income stream, like 6%, 8%, something like that. So you are taking out an income stream, it's just not the full 16% or whatever the yield is quoted as. That solves both problems people have with SVOL. You are controlling your income distributions, so you can make them perfectly consistent, just like you're getting a paycheck every month, and even increase them annually to keep pace with inflation. You're also reinvesting some of the dividends, so some of your returns will be used to compound over time instead of them all being paid out as income. Technically, that won't impact the NAV of the ETF, but it will grow the value of your investment in SVOL over time as you accumulate more shares. Same amount of shares growing NAV or growing amount of shares and a not growing NAV, it doesn't matter how you get there. All that matters is that your investment will be growing in value. Whether you have 10 shares at $20 a share or 20 shares at $10 a share, it doesn't matter. The value is the same. Let me show you how this would have worked over time. We all know SVOL has earned positive returns, right? That's the red line with dividends invested. But we also know that it's had NAV erosion if you've taken out all the dividends. That's the blue line. And we also know that its income hasn't been perfectly consistent and it's been falling lately, right? Well, here's what this would have looked like if you'd implemented my strategy, starting with a $10,000 investment at the end of May 2021 when SVOL was launched. You started with an 8% yield, or $800 a year, split up monthly, so you took out $66.67 per month. Since inflation in 2021 was 7%, you adjusted that income payment upward for 2022 to start taking out $71.33 a month. Then up another 6.5% in 2023 and another 3.4% in 2024, just basically adjusting for how much prices had increased over the prior year. Your income has been steady month to month and increasing every year to keep pace with inflation. That's the blue bars. Your investment value, the orange line, has stayed right around your initial investment of $10,000, dipping below in a downturn of 2022, but recovering in 2023 and 2024, and finishing up just over 3% cumulatively. Not an exciting return by any means, but you've solved both problems, NAV erosion and income instability. Is it guaranteed to work with an 8% withdrawal rate? No, of course not. But in my opinion, it's got a better chance than anything else I've ever seen. If you found this video helpful, hit the like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect with my partner Kyle and I directly, you can do so by joining our Discord through the link in the description below. We'll look forward to seeing you in the next video.